Hi guys, welcome to China Perspective. My name is 𝗵𝗵𝗂𝗶𝗴 and you may know me as the German recruiter in Asia. Today I want to talk about the big question: should you register a company in China in 2025? While the economy is still slow, global events such as lower consumer confidence in many other markets and a bit of a wild west game of geopolitics and tariffs and restrictions potentially popping up overnight put many firms under pressure to consider new partners in the East or simply try to expand their business in places they have not been before. Let's look back a bit at the last year. In 2024, China has seen an increase of new company registrations, both local and foreign. But what does it actually mean for the business landscape? Is it a surefire way to succeed? How easy or how hard is it to tap into this huge domestic market? What product or industry is more or less likely to succeed? Well, there's really no easy answer. The economic environment in China has changed drastically since the pandemic, and at the same time, many local firms have been pushing their business forward and pivoted and innovated. Today, we'll break down the hard facts, the changing trends, the legal environment, and finally, whether your company is likely to succeed in China. So let's get started with the search and registrations and a little bit of a financial and factual overview to put it into perspective. In the first 9 months of 2024, 42,108 foreign invested enterprises, also called FIEs, were registered in China. This represents an 11.4% increase to the previous year. We do, however, have to remember that 2023 was a slow year in general, and 2024 was the worst year to date, at least in my entire working life, for many foreign firms operating in China. On the surface, these numbers suggest that foreign investors are keen to tap into China's market despite the broader economic challenges and a decreased foreign direct investment, also called FDI, utilization during the same period. So what gives? While FIEs have increased, there's a contradiction in the overall picture of foreign investment. Despite the increase in new registrations, the actual amount of foreign capital flowing into China has been less than expected. That implies that while foreign companies are willing to establish a presence here, many are doing so with a more cautious and somewhat minimal initial investment. Next, let's look at a geographical and a sectorial breakdown. Where's the money really going? The rise in company registrations, it's not uniform across China. There are some key cities that are driving the trend, attracting both local and foreign investment due to their infrastructure, economic politics, and talent availability. For example, Hong Kong has seen a record number of company registrations with about 145,000 local businesses established in 2024 alone and another 1,079 non-Hong Kong businesses setting up shop in the region too. Shanghai, for example, is known for its international business environment and remains a hotspot for foreign enterprises, partly because of the centralized registration policy, making it easier for small businesses and startups to establish their presence without needing a physical office. The city has made real efforts in the recent past to make an original, long and bothersome process more smooth. Shenzhen also remains a top choice for tech startups due to its status as a special economic zone that provides favorable policies and subsidies for research and development and access to a deep talent pool in the tech sector. Smart companies go where they find talent. Despite this concentration on major cities, there's also a growing trend of investment in cities like Hangzhou and Guangzhou, for example, known for their strong technological and trade infrastructures. In Hangzhou in particular, it's interesting, has established itself as a leader in tech innovation and started implementing some smart city mechanisms that attract a wide range of businesses. The additional secret sauce of Hangzhou is the so-called Alibaba spillover. So Alibaba had their global headquarters and their tech and their R&D center in Hangzhou and attracted top-notch talent from all over the world to move to Hangzhou. So now many of the former Alibaba employees are now starting their own venture. Up next are the key sectors for investments. Who's winning the vote of confidence for foreign investment? The service sector has emerged as the largest recipient of foreign investment in the first 9 months of 2024, with roughly $62 billion flowing into services. This includes finance, healthcare, professional, technical services, and other high-demand sectors. Alongside this, high-tech manufacturing and medical equipment have also seen significant foreign investment inflows. Many of these new investments, however, are concentrated in a few cities which I mentioned, leaving a lot of untapped potential in less developed regions and creating, well, economic bubbles, if you will. So how about the legal environment in China for company owners? For anyone looking to establish a company in China, recent regulatory changes and updates should be reviewed very, very carefully. For example, each company needs what it's called a legal representative for their China entity. Many of my clients ask their respective China GM or China MD to take this role. Others assign somebody from the headquarters as a sort of fail-safe mechanism. There are quite a few rights and liberties that come together with being a legal representative, but it also comes with legal obligations and can potentially carry personal risks in case something goes very wrong. So please talk to a legal consultant here in China before you make that decision. My company does not offer this service, but if you need somebody, I can refer you. The State Administration for Market Regulation has also rolled out several measures with the aim to streamline the registration process and to help improve the ease of doing business. These changes aim to make China a more transparent and more business-friendly environment for foreign and local enterprises alike. But it is quite an administrative process, and it still really does take some time. So a personal tip, please do not choose the Chinese name of your company willy-nilly. I've seen excellent names and I've seen the most horrible names, and the latter will seriously hinder your business in China. Ideally, your Chinese company name is similar to the phonetics of your actual company name. Chinese is a tonal language, so for each syllable that you have many different words to choose from. Please really make sure to choose the words that have meaning in general, but also have a good meaning and also work together. Nothing screams foreign company that doesn't understand China at all if you just add random words. I really suggest you to give this some serious thought and not letting either a non-native Chinese speaker come up with a list from ChatGPT, because I've seen that, or just somebody decide who doesn't really understand the depths of it. My favorite name is Siemens, which means 𝗂𝗵ci. This means the sun who comes from the west. I love it. Phonetically, very similar. It shows respect and humbleness as putting one as the sun. It has an element of coming home in a family context, creating familiarity, and it comes from the west. So I have no idea who chose it, but I really like it, especially in the context that this was chosen decades ago. But let's get back to the key regulatory requirements which have seen some shifts. Now to the new company registration management measures. Since February this year, 2025, there have been some rules that require companies to provide proof of their domicile or business place during the registration to combat false address information. Next up is the revised company law. So this is a change that mandates that companies' shareholders must pay their full subscribed capital within 5 years of establishment, which aims to improve capital transparency and accountability. In reality, this was more aimed towards local company founders and less towards foreign company founders. We also see a more streamlined registration measure process that has been introduced that aims to standardize registration practices and makes it easier to comply with local regulations. The government is also showing support for high-priority sectors like green energy and high technology, offering targeted incentives to attract investments in these areas. But how about the key risks and challenges for foreign firms? Here is where it gets interesting. Entering the Chinese market is not for everyone. While the statistics suggest a growing interest in new company registrations, the road ahead is far from straightforward. Companies really also should consider the risks. So for starters, some industries remain really dominated by state-owned enterprises called SOEs. These SOEs receive substantial support from the government, making it extremely difficult for foreign companies to compete on equal terms. If you're a firm in a sector where an SOE holds a significant market share, expect the playing field to be skewed quite heavily in their favor. There are also firms who should think 2 times before coming. Here are some criteria of companies that may find themselves in a Red Sea market. For example, if you have an easily replicable product, companies that rely on a unique product or service but are worried about local competition quickly copying their offerings may find themselves at a disadvantage. Chinese firms are increasingly skilled at improving the quality of their products, making them very tough competitors, especially with their local expertise and supply chain here. It's also quite possible that a very good alternative to your product already exists in the market, making it much more difficult to expand. Second is sectors with heavy government control. Firms in sectors that are tightly regulated or dominated by SOEs will face steep competition, not only from other private enterprises, but also from the government itself. Number 3 are data-intensive businesses. If your business relies heavily on unrestricted data flow, China's strict data security regulations, including personal information protection laws and what we lovingly call internet harmonization, may be an overwhelming barrier. For geopolitically sensitive firms, for companies from countries experiencing geopolitical tensions with China, such as the US, the challenges are even higher. Political issues like trade wars or diplomatic disputes can have a direct impact on your ability to operate smoothly here in the market. Also, an unwillingness to localize can be risky. If you're unwilling to adapt your products or services to local needs, or if you're unable to gain the trust of local shareholders, you might really struggle to establish a strong market position. So the big question is, when should you enter? It really depends on you as well as your industry and expectations. There are several opportunities in China for companies that can navigate these complexities that I described. The market is very large and quite diverse, with massive potential for firms that are ready to take the risk and make the necessary adjustments. Companies in high-tech sectors such as green energy and medical devices should definitely take China serious. But let's not sugarcoat it. There's no one-size-fits-all approach. You really ought to be prepared for competition, fierce competition from local players, and may need to be able to meet strict local requirements. The evolving legal landscape combined with local market complexities makes it crucial for foreign companies to really do their homework before committing to the market. And while certain sectors like high-tech, green energy and medical equipment are thriving, others are still facing intense competition and government barriers. So whether you should enter the market really depends on your industry, your ability to adapt to local market conditions, and your long-term goal. Companies willing to face challenges head-on and make the right adjustments will find opportunities. But those who are not ready for a competitive, hyper-competitive even, and ever-changing market landscape may want to reconsider or at least be cautious in their approach. Thanks for tuning in today, and I'd love to hear what you think about it. And like and subscribe to my channel if you want to see more videos. Bye, guys.